We're going to talk today about security tokens, obviously, as what they are, but I'm going to do my best to do an introduction of each of you, having only met one of you before. Okay, so immediately to my left it's Vincent. And so Vincent Molinari of Templum. And Templum is they're a FINRA-registered BD, right? And you're an ATS, correct? There you go. That's the introduction. The next one is Chris Housser. He's from Polymath. Polymath helps you create security tokens. You guys have the ST20 standard, right? That's basically what you do. Boom. He's introduced. Andy Bromberg is from CoinList, which is a platform where some of the biggest ICOs have listed, and some of them we've had on the show. So thank you for coming as well. And finally, we have Igor from Alphapoint, who you may have said a quiet thank you to as you ate your breakfast today. Thank you to Alphapoint. And he helps you. They help you digitize assets and launch marketplaces. Is that right?
That's right.
Look at that. OK. So today we are going to answer the questions about security tokens. So before we say what is it, I think it's helpful to ask, why do we need security tokens? Like, why is that even important? What was that solving? Vince.
Well, I'll harken right back to David's opening comments. And I think if we remove cryptocurrency for the moment, and maybe that's a revolution, but in the world of security tokens or tokenized asset offerings, this is an evolution. So how do we foster capital facilitation for economic growth, job creation in a more efficient way that is fully transparent, that has a defined pathway to secondary liquidity? And the challenges of the IPOs, as David talked about, these are many things that we worked on together going into the Jobs Act. Tremendous shortfall in the IPOs, and I'm not sure they're coming back anytime soon for the small to mid-tier offerings. So tokenization of securities and pathways, I think, is the next generation of how we close that gap.
Yeah, for sure. And you mentioned, like, there's you said efficiency, you said liquidity. There's a whole bunch of things. So why don't we have that now? What is now, Andy?
Yeah, I think there's a couple stages here. The first is that a lot of assets today are not digitized, and there's two steps to get to tokenization. The first is, should we take assets that are handled on paper or physically and move them into the digital world? And then there's a next step, which is, should we tokenize them as that path to digitization? And the digitization does a lot of these things. It allows for 24/7 markets. It allows for fractionalization. And so then you have to ask, why should we actually tokenize these assets? Why should we use tokenization as the method to digitize them? And actually, our co-MC, Steve McKeon, over there, wrote a great article on this the other day, the security token thesis, that I recommend you read. But the most compelling argument there for me is the interoperability. That by building these things in a tokenized manner, we actually allow the assets to be traded for each other in a liquid and compliant manner. And this digitization step needs to happen. It's been inevitable for a long time, but the tokenization step of allowing for interoperability between these assets is one of the things that's really compelling to us. And it just hasn't happened yet because the technology hasn't been there. We talk about securities tokens, there's only a half dozen out there today. Yeah. And we really need to get more. And so now the technology's been developed, we're all here to learn about how we can move forward in that ecosystem and start to make this happen in the coming months.
Yeah, that's great. So yeah, we're pre-birth. It's very interesting, because even when I think, and I talk to everyone all the time, and I think, I totally get this. And then when I talk to explain some other aspect of it to me, I don't get this anymore. So, but let's start, there's the compliance aspect. So there's ICOs, and then suddenly everybody, as Aubrey was mentioning, that ICOs, everybody needs to get in. Oh, everybody needs to get out. Okay, so why will compliant ICOs or STOs or whatever we want to call them, why are those going to be so important, and how will compliance actually live inside of a token? Chris?
Yeah, with securities, the Securities Act from 1933, 1934, the Howey test from the 40s, there's all these old regulations, and we're not trying to break what these rules and regulations are. We're trying to, how do we fit and comply with these regulations within the new token economy? And really what we're doing with Polymath, and what I think a lot of other companies are doing, is we're creating tokens with identity embedded in. So you need to go verify yourself, demonstrate that you are, let's say, an accredited investor, if that's what's required under the offering terms. And then only those people who meet that criteria, who are on the whitelist, are then able to hold these security tokens. And I think that's really the next step forward to bringing this security marketplace in the token environment forward, is how do we restrict the trading of tokens to only those people that are allowed to do so. And that's really what we're working on at Polymath.
Yeah, so how does someone who is, of the old world supposed to feel confident enough to be, you said there's like 6, right, of the security tokens now. Like how does somebody go from, I have an actual market cap and it's in the hundreds of millions. How am I going to feel confident that I can digitize, make a security token and do this without screwing everything up? Let's just say, I'll change that F to an S. Igor, how does that happen?
Sure, so I think one of the important pieces has been to see the technology in action and to see it occur, with the Bitcoin really is where the industry started, right? And at Alphapoint, we actually turned 5 years old today.
Hey, mazel tov.
So we've been in the space and we've really kind of seen the evolution. One of the early pieces that really excited us as a company, coming from capital markets and seeing what the new technology could do, was really this transition of natively digital assets like Bitcoin, Ethereum, other cryptocurrencies, and applying the technology to securities and other types of asset classes. So the piece to give comfort, one is the comfort in the technology, which I think the experiment has succeeded in the actual code not being compromised for many years, and really the evolution of new types of blockchains that can enable smart contracts, right? And the evolution of smart contracts is what's giving that comfort to Wall Street and other issuers that are looking to bring these assets onto the chain, and also giving the comfort to regulators, to reduce frictional costs, to increase the velocity of transactions and liquidity. Regulators also don't want that to be an open, free market. They want the same securities laws that apply to be applied in the new technology, and we have ways now to, via smart contracts, enforce the regulations in real time. So you can drastically reduce the compliance cost of Wall Street, which is a huge cost burden on the industry today.
So that touches on one of those the benefits, is efficiency. What else? What are the other efficiencies? Yeah, sure.
And if I can just interrupt there for a second. So the efficiency is awesome, right? So technology today could do many things that make our financial service market more efficient, but in many instances, the regulation is not up to speed yet,
how
right?
so? Yeah, we hear that a lot.
Well, it's the modernization of security law that intersects with the most innovative technologies, and that really was a large part of the Jobs Act, right? The revisions to 12G, the removal of general solicitation so you can advertise, the increases of Reg A+. So as much as we may have technologies that can blow things away, you can't pretend that we're not clearing, settling, or depository, or doing a trade. Therefore, you have to be licensed and regulated. So it's great if you could drive a car and you can drive really fast, but if you don't have a driver's license, guess what? You shouldn't be driving. If you get pulled over by the police, you're in a lot of trouble. If you get into an accident, you're totally screwed.
Yeah.
So we're at this inflection point in the marketplace, although it's very early, right, and we're inflecting. We're in ATS for the past 2.5 years. We are actually approved to conduct digital assets as securities and ICOs. We're in 50 states of the United States, so blue sky requirements are there. We built provisions, as David said, to preempt and think about 12G. So it's how do you intersect and collaborate with regulation as it exists today, not where it's going to be potentially in a year or 3 years, and with the best technology that we can implement into that today.
So do you think 2017 was sort of an example of people selling cars to kids and saying, go drive 150 miles an hour? It
was selling cars to kids that probably had nitrous in it, right? So,
right, that's nitrous, right.
Yeah.
Punch it!
So
no license.
I think there's going to be lots of speeding tickets coming, and maybe some others, right? And that's a transition in the marketplace, right? So taking the best of what we learned from great cryptologists who put this on the map and collaborating with regulatory frameworks to holistically expand this so that we have that comfort. So institutional large pockets of capital say, wow, there's AML, KYC, suitability requirements. There's reporting practices.
Right.
There's validation of these assets. And that holistically is going to build this space extraordinarily large.
So this is fascinating because that is definitely the compliance part. Like we need compliance, but we're talking about efficiency. And so are those at odds? Like, is it that if I have to be compliant here, can I go to Malta and just say screw it? I'm going to do this in Malta.
Yeah, to jump in there, I think to go to what Vince and Chris are both saying, efficiency, the people are acting like this is a whole entirely new regime and we need to figure out new rules for every little bit and piece. But a lot of what this technology can do is make compliance more efficient. So we look at things like ST20 that are building these compliance layers on top of tokens. That's actually not a new kind of brand new concept. Historically, we've had transfer agents. And when you trade a security, it goes to a transfer agent who checks and makes sure that the trade is legal, that the counterparty is allowed to accept that trade, that the person trading it is allowed to sell it. And that's an important function in the ecosystem. What a compliance layer on top of a token can do is make that more efficient by automating that compliance process and saying, wow, are these two parties actually allowed to make this trade? And for us, we look at that and say, you know, the compliance layer has existed before. It just happened to be a human and a process that was sitting in between this trade and stopping it from moving as quickly or efficiently as possible, and perhaps even taking fees on top of that in a meaningful way. Let's see if we can use this technology to make that whole process more efficient and allow those trades to be conducted in an automated manner, perhaps even peer-to-peer. And so when we look at the compliance, like Vince was saying, it is a matter of taking these existing regulations, these existing rules, and these existing processes, and making them more efficient through the use of things like smart contracts, like Igor was saying, or other technology that we can build in the middle, rather than having humans in the middle of every single transaction.
So yeah, that's a great point. It makes super clear that we're just digitizing transfer agents. There you go, done, boom. Sorry, transfer agents, but that's great. So, but what about this idea of there's all of this activity happening in places like, you know, Estonia or, you know, Switzerland or wherever. Is by the security token phenomenon, is that giving sort of a predictable access for those activities to access a US market? Or is it just going to become, there's the US and then there's everybody else? What do you think about that?
Well, it all goes to regulatory frameworks. So if we're looking at Reg A+, Reg D, and Reg S, there's going to be sovereign nation issues, currency flows that have to be dealt with depending upon those jurisdictions. Right. But put it in perspective, there's $2.4 trillion of unregistered security issuances in the United States alone, compared to our aggregated public markets that were 1.6 trillion. So if you think about the trajectory, again, I'll go back to the Jobs Act, the ability to efficiently access capital, the education that went on from the Jobs Act to today, and the ability to capture alpha early in the cycle of a private security has created valuations, a la Spotify, pre-listing on the New York, of a public company valuation in the billions. So we have a huge market. There's plenty for everybody here in the US alone, and that's where we see there's much collaboration that's going to happen with other folks. You know, do we collaborate with a CoinList, right? All for that, right, holistically. Harbor and Alphapoint and Securitize, as we build common standards and best practices to help this space grow. How that continues globally, you know, it all depends on the cross-border functions and regulatory frameworks.
So, yeah.
Yeah, so we have customers in about 35 countries, right? Mm-hmm. We have close to 80 customers now in, you know, almost half as many jurisdictions. And so we see what's happening jurisdictionally, globally, quite a bit. And there is going to be a bit of, you know, the US investors are always going to be under US regulatory jurisdiction, regardless of where the exchange, right, you know, that's providing the liquidity is. So you know, exchanges globally are quite mindful of that, and most of them have to date taken a, you know, stay away from kind of US investors point of view, which, you know, is going to happen until there's a lot more clarity and in the licensing. There's also a bit of regulatory uncertainty of how to define a securities token, right? Which I think is kind of the theme for this panel, and you know, where the SEC here initially took a pretty broad stroke of saying, well, if, you know, haven't seen an ICO that isn't a securities token, right, that's been walked back since, yeah, you know, where, you know, okay, Bitcoin, Ethereum, maybe those are a different type of token, maybe other types of tokens can exist. Israel had a different framework where they actually are defining what a utility token is. Because you can go quite far. You could say, well, an Azure, you know, a license key to Azure could be a token. Right. Is that a security? You know, probably definitely not. So there's still some space here of, you know, securities token that represent underlying ownership rights or underlying, you know, coupons, dividends, you know, interest payments. Those are clearly securities, probably anywhere,
right, those are the
globally.
Easiest ones, right?
Those are the easy ones, but there are some that are in between which are yet to lots that are yet to be defined.
Yeah, that's fun. So I don't know if this is too caveman, but as a caveman, I'm going to go there. So Chris, I think you mentioned the Howey test. Just in case people, so we all know what we're talking about. Can you, if off the top of your head, can you list what the conditions in the Howey test were to determine what's a security? Do you know?
It's the investment of money, and you could definitely define Bitcoin or Ether as money to satisfy this test. To a common enterprise, so a company is doing an ICO, that's a common enterprise. With an expectation of profit, are you buying into this ICO, or are you buying this token because you expect a return, or because you expect to use that token on a network or for some other purpose, and then based on the work of others? Right. So you're giving this common enterprise money, they're going to grow their platform, and then are you going to use that token, or are you going to flip that token and make a profit? So if you pass all 4 of those criteria, then you pass the Howey test. And it's not a test you necessarily want to pass, because you'll be defined as a security.
Right.
But can I just jump in there for a sec? Because I do think the SEC has made an interesting, very precise statement here a few times, which is that they haven't seen, Igor mentioned this, they haven't seen an ICO yet that isn't an offering of securities. But I think what's interesting there is that they did not say, we haven't yet seen a token that isn't a security. They've just said we haven't seen an ICO that isn't an offering of securities. And so that suggests that perhaps, and they've in fact said this, albeit in informal conversation later, that something could transition from being an offered security to a non-security at some point in the future, perhaps when it begins to fail one of these prongs of the Howey test that it may not have failed earlier.
Oh, that's interesting.
And so yeah, the idea that these ICOs have all been offerings of securities, at least in the SEC's eyes, but that at some point something like a Bitcoin or an Ethereum perhaps could become a non-security is an interesting perspective. Obviously not true for these things that represent ownership and underlying assets, but for this broader set of tokens, it might be possible for something to transition out.
Can you just say, Vincent? Yeah.
Yeah, so I think that's great and it's clear, but I think if we look at Chair Clayton's statement just Friday, they're not going to change any security law to accommodate anything in this framework of security tokens. So I don't know if they're punting to the courts to make decisions as they're going down the path, but there's not a mechanism in current security law that allows us to move from a security offering to convert to a utility token or something else in the future. Right? Could that be a great thing and very healthy for file storage, for app development, for machine to fan base, where a utility token is awesome? Absolutely. But when we start in the beginning that it is a security, I'm not quite sure how you extinguish that security and end up with a utility token just yet.
Yeah, I mean, on the show, we've been talking more suddenly in the last month. We've been talking to companies that have decided to start with 2. They would say, here's our security token to raise the money, and here's our utility token to do what we do. And that seems so clean. I mean, is that the future?
That the commission has certainly given guidance where there's an ability if it's a bond, a dividend, to have at the option of the holder to accept a crypto as payment. So you can be creating in that mechanism, as they give their guidance much more Bitcoin-like, right? So there's an activity associated with that. So I think there's going to be lots of movement, whether it's the dual token strategy or some decoupling, but you can't just extinguish the security token, becomes the key portion.
So this, I think, is also interesting for the caveman. So it's hard to wrap your head around, like, what exactly is this thing and how does it work? Like, if I were starting a company and I was convinced, oh, this is the future, let's do security token offering. We need security tokens. How do you guys help me become a successful, issuer, having raised the money I need? I mean, maybe Igor, you want to start?
Yeah, so we're more of an infrastructure provider, so we wouldn't be the one typically working directly with the issuer. But so we provide the technology by which it can be issued, multiple issuances, and then also we provide the technology to launch the secondary markets, right? So whether that's a ATS licensed exchange in the States, if it's it could be an international exchange under a different jurisdiction, whether it's both for securities tokens as well as non-securities tokens. But the general process is this is a new vehicle by which issuers can bring in capital for their project, right? And We do believe there is room for both utility tokens and securities token, but if it's a securities token, we have one customer, Muirfield Investment Partners up in Boston, right? They're a PE firm. They're currently investing in real estate. So they're doing a $200 million issuance for a securities token that will represent the underlying interest in an LLC that holds real estate investment properties, right? So the token holders will be accredited investors, you know, Reg D, Reg S, and they purchase the token. They store those in their wallet or by a third-party custodian that will store that token for them, and then coupon payments can be made directly on the chain, right? So if you have a secondary trade, you trade to another accredited investor. We have a concept of a regulated asset-backed token framework. So you actually have these oracles that do the KYC on the users. So accredited investors, once they're certified through the KYC process, they can always do secondary transactions. They can do it on an ATS for more liquidity, or if they know other parties that are holding, they can go to that party, purchase the tokens, and then when a coupon payment is made, it is made out on the chain, and the smart contract just pays it out to the current owners of that token. So you can start to see some of the efficiencies of the token holders. You may want to invest in this more because you have transparency. You can see all the historic token payments. You can see the entire life cycle of the asset. You can see all of the associated paperwork with that asset, essentially by via a block explorer, permission block explorer, seeing that entire history of the asset. So that's maybe why an investor would want to get access to this asset class, because it's going to be easier for them to get secondary liquidity down the line.
For sure. But this is going to be interesting. Raise your hand if you own a hardware wallet. Oh shit! All right, I was totally wrong. Okay, I thought it would be 1 in 10. Okay, but this is the Security Token Academy conference. I guess I set myself up for that one. But I think that isn't one of the problems that people get it. Like, oh, that's going to be the future. And then when it comes to going into their home office with their dog, I'm like, okay, how do I start? Oh, God, this is overwhelming, and I don't know what wallet. Can I lose my key? And then you read the stories about the guy who left his hard drive on his airplane, whatever. What is the actual mechanism that, we know that the token can do KYC and AML, but what does that literally look like in the real world to like me in my office with my dog? You need to know, I'm the customer you need to K. I'm the C that you need to K. What do I do? How does that happen?
Custody is it's a major issue and problem in the blockchain space in general. Let's say you own a security token and you own 1% of a company, and then you go and you lose your private key. You can no longer transact in this equity of the company that you own 1% of.
Right.
It's gone.
That's a big problem. I mean,
so there needs to be solutions created for that, and how can you prove the loss, create new tokens to recover that loss, and that's stuff a lot of people are working on to figure out, as well as custody solutions, so you don't have to hold your own private key with your dog in your own home office.
Right.
So there's a lot of companies that are working on custody solutions as well, but getting to your question about KYC and verification, the way we see it working with Polymath is if you want to invest in a security token, the issuer says, along with their legal counsel, that you need to be an accredited American investor. You'll go through all the process to demonstrate that you meet that criteria. You will provide them with your Ethereum address, 0x123, whatever it may be, and they will add that address to the whitelist. And now you're able to transact that security with anyone else on that whitelist, including ATSs and exchanges that also transact that particular security.
Right, so it doesn't perform KYC AML. It whitelists those who have been confirmed to comply with those rules. Right?
It restricts trading to only those who are verified.
There you go. Okay.
Whereas with the current blockchain, you can send any Ethereum token to any Ethereum address.
Right.
And now with what we see with security tokens, you can't just send them to anyone you want. They have to only go to verified people or authorized people.
Right, and that is, again, that's a great efficiency, and it saves a lot of people a lot of time. Were you going to add something, Vincent?
Yeah, and I'm sorry, I haven't gotten to know Chris as well as Andy and Igor, so I know we have lots of common thinking.
You can still interrupt him here.
No.
I endorse that.
Well, look, end of the day, all these processes are great, but you have to be able to execute. What are we doing at the end of the day? You're investing in a security, you're trading at clearance, settlement, and depository. So this is about new market infrastructure. So the great thing I think about Templum markets, because we started as Liquid M 3.5 years ago, is the fact that we can raise capital, and we have done today. This was a Reg A offering, a Series A offering of a tokenized instrument. One token equaled 1 share of common equity, right? So very simple to understand, right? The beauty of the smart contract is you can create new security instruments, profit participation, yield instruments, revenue participation, or a combination of them. So you can really create dynamic instruments, and it could be around real estate, it could be around other really illiquid traditional assets. But the regulatory framework, and to do that, so regardless of the regulatory compliant processes that we have, with tokens, which are awesome, but still have to execute through a broker-dealer, right? In large case. You largely still have to execute through an alternative trading system to have secondary liquidity. We've conducted our first, what we think is the world, or US first, security token on a regulated platform. So the processes are built. What then we're doing now is the back end, right? It is the transfer agent. Why is the transfer agent so important? Aside from 12G, as David talked about, right, it's the ability to have redundancy. So maybe not as efficient as we would like, but if somebody lost their key or we have backup at a transfer agent, right? So it's not, woe is me, I lost whatever it is. Okay, we can replace. We put unique identifiers on our tokens so they can be tracked and audited through the life cycle. Going back to, and I hate to keep going back to David, but he's the oracle.
He's the oracle.
But when we look at cyber terrorism and we look at cyber fraud, if you can reduce the incidence of hacking because you have tokens that have unique identifiers, and then they can't be used for nefarious things. They can be extinguished if they're stolen. So it's really holistically looking at new market infrastructure. How does that play with the best technologies? And how does it execute through current regulated broker-dealers and ATSs? Peer-to-peer could be awesome. I think we still may have some challenges as we evolve. Are they swap execution facility platforms? I don't know yet what the regulatory framework of that is yet. Very efficient, but you still have to clear and trade that. How does that process happen?
Yeah, it's fun for me to have these conversations because it always feels like we're talking about taming the tiger, because this whole thing started back with these like anarchist philosophies and these treatises about total anonymity and distributed everything, and in practice, when the huge upside, the markets with the T, the trillion, the quadrillion, you kind of have to like put a saddle on that beast and make it work for you. And I think it's exciting to see how everybody's doing it in different ways. So we talked about efficiency and other things, but I think there's the whole other part of the application of security tokens is this fractionalization of like the tokenization of global assets. How is that different from some of the things we've been talking about? I know it's certainly going to be the same in some ways, but what either opportunities or concerns live there? I mean, Andy, do you have any thoughts about that?
Yeah, sure. So fractionalization is a really interesting trend. It's happened in other asset classes. I think tokenization is going to allow it to happen in many more. But I look at one of the biggest advantages of fractionalization as a decreased cost for structuring products. And I hate to go back to the efficiency point, but higher market efficiency in structured products. You look at a REIT, right? And the way that's built is someone buys up ownership of a bunch of different properties and bundles it together and sells you a fraction of that total ownership by creating this vehicle that you can purchase. But in doing so, they're charging you a fee because they've done work there in buying up those properties, structuring the product, and then selling it to you. And so they're charging you a fee on top of the underlying asset value that you're actually buying. So if you buy 1% of the REIT, you're buying 1% of the stakes in all the real estate in that REIT, and they are charging you more than that because there's a fee on top of that for them doing that work. And what's so interesting here to me about fractionalization is if we imagine, Lower Manhattan, all the buildings in Lower Manhattan are tokenized, and they're tradable on these liquid and compliant markets. Perhaps I could go out and automatically buy 1/100% or whatever of all of those buildings and effectively create my own Lower Manhattan REIT without someone needing to structure that product for me and charging me fees on top of that underlying set of assets. And so when you start to look at that for all these different products, it allows for both more efficient structuring of simple products, but also bespoke products that if I think I have some market intelligence that a certain building here is overvalued, I can build my REIT without that building in it, without needing to kind of go and have someone structure that product for me. And so by fractionalizing all these different assets, we allow individuals and different firms to create their own products at dramatically reduced costs with increased customization, which is something that just hasn't been able to happen in the market so far.
Yeah, now that's exciting. Okay, so when David spoke, and I know we have to keep talking about you, David, but you mentioned something about that he just sort of threw in there that the liquidity premium idea. I forget which thing he was talking about, but he threw out the number 6% just by creating tokenization. Is that something we can expect? Is that going to vary across asset classes? And what is a liquidity premium?
So what we've seen some studies, and we kind of look at it as an illiquidity discount, right? So and we've seen studies that show that there's an illiquidity discount of 20 to 30%.
Whoa!
Right. So it's a substantial amount for certain asset classes. They may trade over the counter, and they're just not inherently as liquid. So the opportunity to take 11 trillion worth of assets and eliminate even part, I don't think we're as optimistic to say this is going to eliminate, that entire discount, but even half of that discount coming back into investors is a huge opportunity.
Can you give an idea of like which classes suffer that way more than others, or do you have an idea?
Even bonds, even asset classes that you traditionally think are quite liquid, commodities, gold, silver. They're actually quite opaque markets, and there's big spreads that are charged on both sides, right? So if you make those markets more efficient, it's gonna take some of that discount away. And even something like gold, you had a question of what is fundamentally different in this asset class. You can actually structure the tokens to represent the underlying ownership in the asset, and we have more and more issuers that are going to provide physical delivery or settlement on, for commodities, example, gold with the Royal Mint and CME Group, which are customers of ours. So, instead of buying an ETF, a gold ETF, and you just, it's cash settled, you can actually have physical delivery and settlement of the underlying asset.
So that's interesting. So is there going to be, the use cases are the next thing I want to talk about, but, you hear, I always love the outliers, but obviously, like you were talking about the real estate REIT of your own, it's like Adam REIT, yay, I don't like that guy, so I'm not going to put him in my REIT. But what about things, you've heard about like maybe fine art, or, that, Eli Broad is in LA, he's got, some $20 million painting, but he wants other people to have an opportunity. Is that going to happen where I'm going to make people buy into some, Picasso? And then even further out there, what about things like, and I might get this wrong, but is it the ERC 721 with the unique, where there's one thing of it? So now is it like baseball cards? We would have like fractional ownership of like extremely valuable Pokemon card collections? What's going to be included?
Yeah, that's definitely very possible. I think I saw the other day there was an Andy Warhol painting that was tokenized.
Oh, already?
Yeah.
Oh, look at that.
I foresee a lot more art and other collectible assets becoming tokenized, and now you can own a small percentage of it. And the question is, where's the art piece going to be housed? And I'm hearing ideas to put them all in a museum, and now you own a piece of the art, and you can also get fees as people come into that museum to look at the art. Your token can now give you a percentage of all the admission fees to that particular museum. So there's a lot of ideas out there, especially around the art world, about how do we tokenize this, and how do we now give people access to multi-million-dollar pieces of art that they otherwise would never be able to own themselves.
I love the tokenized art gallery or museum. Yeah.
I do think that for a lot of these assets, art in particular in that category, the majority of the equity, if you're willing to call it that, in the object is not going to be tokenized, or if it is, it's going to be held by a single party. So you can imagine, a piece of fine art, 51% being held by the original owner, tokenized or not, and 49% being sold to token holders. They get economic upside in that piece of art. But when you start to talk about the governance of a piece of art and who actually owns it and where it's placed, I tend to think that will remain decided by a single party, because on-chain governance of a piece of art, what does that mean, right? If you have people voting on where to put this, I think that's a way more challenging problem and doesn't really get at the core of the value of what we're doing here. which is democratizing this ownership and allowing people to gain upside in something they might not otherwise have access to. So if I own 1% of this piece of art and it appreciates 10%, I can sell my stake for 10% more. I've made money on it. I don't really care about deciding where that piece of art goes. And so I do think that the majority of that equity will remain held in a single person's control, so that they can put the art up in their house or put it in a museum or whatever it may be, and allow others to get access to the economic upside, but not necessarily the governance.
Yeah.
I hate to be the old guy in the room all the time.
Hey, be the old guy.
I think if we make it relatable, this is very much akin to structured product, right? Or securitization of things that we've done for a long time, right? So it's a new asset. The beauty of the tokenization is it is allowed to, again, be more efficient. The other side of this great access to capital is wealth creation on the other side. So I think whether that's where the part of the arb is, if it's a 20 or 30% discount or a 6% premium, that space in the middle for marquee assets, right? If you think about marquee real estate holdings that individuals that didn't have 10, 20, 30, 50 million to invest could invest $250,000, they're willing to pay a premium to access that marquee asset, whether that's real estate, art, or the premier securities that they couldn't get into typically because it was a bit of a club. So I think tokenization in a structured format or structured product format is going to revolutionize many illiquid asset class that drive them from discount to at least par, if not premium.
So are there any places where, Andy, you're talking about the challenge of governance. Is there anywhere where that becomes an opportunity, where because it's different like that and that everybody has such a say? Is there any use case where that becomes an actual opportunity for something to happen that hasn't been possible?
I think some people would argue that, I see that as more of a philosophical debate, that some people would argue, hey, the wisdom of crowds is really powerful. We should let this company, this entity, whatever it may be governed by the crowd. Others will say, let an experienced manager take control and decide what happens with this asset. I don't know that I would say there's, kind of on the whole, things that are objectively better governed by a democratized set of investors versus governed by a controlling party or something else. But
I've
there are
never
certainly
seen it
people
be better, but
that would make that argument.
Yeah, it's an interesting philosophical question.
Yeah,
but in general,
Igor.
I think the corporate governance models, that's just an opportunity for firms, and there are some that are starting to tackle and approach this already. It may be not for a piece of art, but for another entity. Corporate governance and bylaws, bringing those into a smart contract where the majority of the token holders or the majority of preferred, et cetera, is going to have certain governance rights. That is very much, going to happen, right? It may not be for that piece of art, where I generally agree, it's going to be one owner most of the time. But for other asset classes, for when you're tokenizing a company, private shares of a company, you may have subclasses of those shares, and then governance rights, voting rights that are subject to the stakes in those tokens.
Yeah. Proxy voting is something we're building into our tokens as well. So the ability to pay dividends, the ability for the token holders to vote, that's definitely features that we're looking
all baked
to build in. Yeah.
Look at that. So what about the idea, is this all going to be accessible only to accredited investors? Is this going to be like Reg D? Or are we going to see this ultimately investable by Main Street, and where and how is that going to happen? Old guy.
Look, it's the evolution. I think path of least resistance today is Reg D because of without having to go through a comment period and so forth with the SEC on Reg A+. But the marketplace absolutely needs the retail engagement and further democratization.
Right.
From a compliance suitability requirement of a broker-dealer, much harder, right? But yeah, absolutely. So I think Reg A+ is going to represent a wonderful opportunity. I think it's been a hurry to get to market for most issuers, so they don't want to wait that 90-day period, or could be longer, for the SEC approval. So Reg D seems to be the path, which is clearly locking out a lot of the, at least initially, the retail environment.
Yeah, what's been eye-popping, definitely going back to 2017, and for me as, again, the caveman, is just the insane amount of money available through a Reg D. Just like, you don't need anybody, just boom, everything's oversubscribed, everything, double, triple, woo, 3 weeks done. It's like, I've never seen anything like it. But, so, obviously the appetite to get into this from accredited investors, institutions is, kind of obvious now. But there's so much, maybe from a making the world better position, you need to have Main Street in it. I would hope, I guess maybe this is just me being philosophical again. But or when are we going to see that? When do you think?
So I think there's a rush for brokers and wealth managers globally to provide access to this asset class as a whole, whether it be natively digital assets, cryptocurrencies, or the securities tokens. There's a wave of those institutions starting to integrate, and we're working with many, some of which that are announced, some of which that are not, around just providing that access to their retail investor base. So for securities tokens, I think that's the way it will go, right? Is that the retail base will have their access via their traditional channel, their brokerage, Fidelity, et cetera. But for asset classes that are, commodities or, digital currencies that kind of fall outside of that securities token purview, there's a lot happening with decentralized exchanges, with lower friction, marketplaces globally to provide that access, to democratize the access to these asset classes. And we believe that's going to continue to proliferate as well.
So back to my home office and my dog, am I going to sit there eating popcorn, looking through my E-Trade account and being like, I would like a piece of a Picasso and 1/800,000th of the Empire State Building and my neighbor's house because he's tokenized his house so that he can get some, 49% of his ownership to get liquidity? Is that what it's going to look like in my E-Trade account?
I don't think that that's an unforeseeable view into the future.
Right, amazing. So when we look into the future, what do you guys see in the next, let's say, you can't look too far, everything changes like every day, but let's just say 18 months, just to make it far enough that you can go pie in the sky. What's it gonna look like 18 months from now?
Security tokens will prove to be the most robust tradable asset class, growing, the biggest conduit of capital aggregation, job creation, economic growth within a regulatory framework that gives, particularly as we get custody, clearance, settlement, and depository, will be the gateway to massive amounts of institutional capital flowing into the space and will forever change the paradigm of asset classes.
So not much.
Yeah, just a little.
Chris, what do you think 18 months from now?
If you look at the total asset value of all the crypto assets right now, it's about $300 billion. And that's represented 99.9% by non-identified security tokens. It's arguable if some of them are security tokens, but they're not self-identified as securities. And I think going forward, one sovereign wealth fund, a few big companies tokenize their security. That number can easily triple, can 10x. So the utility token market cap, it may remain around where it is right now, but the security token market cap going 18 months ahead could easily be in the trillions.
Andy.
Yeah, couldn't agree more with what those two said. And I would just add that we'll see a huge class of traditionally illiquid assets become liquid, and we'll continue this kind of never-ending march towards markets for everything and liquidity for everything. And we'll begin to see how those efficiencies start to play into these markets as things that have always been illiquid, only been accessible by a small set of investors, become accessible to a much larger set of investors, and see how those markets develop.
What do you think, Igor?
Yeah, so I agree that the crypto assets as a whole will go above $1 trillion. I like to point to a World Economic Forum study that the majority of respondents responded that they believe that 10% of global GDP will be on blockchain by the year 2024. So that's about 8 trillion. So 18 months, getting over $1 trillion, I think is definitely feasible. I think the other piece that will be solved within 18 months is custody and assurance of these assets, is getting big name custodians into the space, providing traditional investors with that peace of mind that these crypto assets are in good hands.
Right, great. Well, you guys, thanks so much for clearing up this for everybody here. And yeah, you have perfect. See, look, that's not my first rodeo, baby. Wow. So thank you all for listening. I hope it was helpful, and let's give it up for the panel. All right.